I'm Larry Walther, and this is PrinciplesOfAccounting.com, Chapter 5, which deals with merchandising operations, although the principles you'll learn in this chapter extend well beyond merchandising businesses. In this particular module, we will look at the sales activity, or the accounting for the sales cycle for a merchandising business. Now, merchants are businesses that buy goods and resell them, presumably at a higher price, and this gives rise to some new terminology. So sales minus the cost of what's sold gives rise to gross profit. Gross profit for a merchandising business is typically reported as a separate or segregated area. So gross profit is reported on the income statement as an intermediate amount. Notice how important it is to track gross profit. If the gross profit rate is low, an increase in sales volume may not increase overall profitability by a very significant amount. On the other hand, a business that has a very large gross profit rate can have marked change in their overall profitability. They're very sensitive to their sales volume, in other words. Now, another category of expenses are operating expenses. This is the general category for selling general and administrative type costs. And if we look at an income statement presentation, what we'll see is we have sales minus cost of goods sold, giving rise to the intermediate total gross profit. That gross profit is reduced by a collection of the other operating expenses, which results in the net income for the business. Continuing on, let's look at the accounting for sales. Sales is the term we're going to use, the account we're going to credit for the revenue transaction related to the sale of goods or merchandise. So here I have the same transaction, except one time I'm recording it as a cash sale and another time as a sale on account. In the cash sale, I'm debiting cash and crediting sales. In the sale on account, I'm debiting accounts receivable and crediting sales. Let's go on to consider sales returns. Oftentimes a customer may return merchandise, which gives rise to the need to record a sales return. Now, you might think, well, I'll simply debit sales and credit accounts receivable, undo the sales transaction. However, it's far better to maintain a separate sales returns and allowance account. So here we're debiting sales returns and allowances rather than simply debiting or canceling the sale. By setting up that sales returns and allowance account, it's a contra revenue account that offsets against the gross sales or the total sales. It gives us a very clear sense of what rate of return we're experiencing. It allows us to track those sales returns in relation to overall sales. Obviously, the credit is to account receivable since the customer's not paying. And when we credit that account receivable, we will issue what's called a credit memorandum. It indicates we're crediting the customer's account receivable, reducing or relieving the account, not expecting the customer to pay since they returned the goods that they had purchased. Here's an income statement presentation with a more expanded disclosure. Here I'm showing how sales returns and allowances are applied against the gross sales to come up with net sales for the period. The allowance refers to reductions in price due to minor discounts, so we have sales returns. We might also have sales allowances where we say, hey, you know, the good had a defect. If we reduce the price and you keep it, can we settle up for a lower amount? So both sales returns and allowances are handled in a similar fashion. Another concept to consider is the idea of discounts. A list price might be a catalog price amount or a stated price amount, but it may not reflect the actual intended sales price. A business may give a trade discount to a particular group of customers or to anyone that negotiates for that discount. These trade discounts are ordinarily not recorded in the accounting record. They could be, but ordinarily they're not. We normally just record the sale at the agreed upon selling price rather than the list price, the sales price minus the trade discount. The invoice price is the amount that the customer owed. It's the list price less the trade discount. This is the amount that's ordinarily recorded in the accounting records. Merchants may issue credit cards of their own. The benefits are that they induce customers to spend more. We're able to track the spending habits of our customers. We may also be able to charge fees and interest amounts that would cause the overall revenue of the company to increase. There are costs associated with credit cards, however. Some customers may not pay, giving rise to bad debts. And in addition, you may have to maintain your own credit department for billing and determining a customer's credit worthiness. So a lot of merchants, instead of issuing their own card, will just simply accept a general card like a Visa or MasterCard. The billing and collection is handled by the credit card company. The credit card companies, however, charge rather steep fees to the merchant, usually in the range of 1 to 3% of the sale amount for providing this service. Many merchants record the full amount of the sale as revenue and later recognize the service charge as an offsetting expense. In fact, we'll look closer at credit card transactions in a subsequent chapter. Finally, let me close in speaking about cash discounts. Some merchants may extend a discount to their customers, a reduction in invoice price to encourage early payment. So you might see on an invoice terms such as 2/10, N/30. This indicates that a 2% discount is available if payment occurs within 10 days. Otherwise, the net amount is due to be paid within 30 days. An entry needs to be recorded to deal with the cash discounts. At the time of a sale where a merchant is extending a cash discount to a particular customer, we'll go ahead and record the sale at the gross amount. Here's a $1,000 sale on account. We'll debit accounts receivable and credit sales $1,000. If the customer pays in time to take the discount, however, notice that we'll actually debit cash $980. That's the $1,000 minus the 2% discount. But we'll reduce the account receivable for the full amount since it's now been totally satisfied. The difference of $20 is debited to a sales discount account. This entry reduces accounts receivable by the full invoice amount, and the discount is recognized in the discount account. Now, it's possible the customer will not take the discount. They'll simply pay the full $1,000 amount too late to get the discount outside of the discount period, in which case we'll do the normal thing, which is debit cash and credit accounts receivable to reflect the conversion of the full receivable into cash. In a subsequent module, we're going to see how sales discounts appear in the measurement of the net sales for the business and would appear on an income statement for a merchandising concern.